Hello, so I'm Gary Markham from Land Family Business, which is a tax and accountancy practice based in Cambridgeshire, but we operate throughout the UK in providing tax and accounts advice to farming businesses. And so I've been asked to say a few words today about comparing regenerative farming practices against traditional practices. Now, I just need to say that traditional farming practices do actually incorporate quite a lot of minimal tillage, etc. And so it's not just all ploughing versus regenerative. Okay, so we benchmark quite a few acres, up to 100,000 acres, and I have been benchmarking around about 20 farming businesses in Cambridgeshire and in East Anglia, basically, of actually regen farmers against the traditional farmers. So I'm going to go through a few figures in the next few minutes to look at the results of that benchmarking. Okay, so initially I need to say that the figures are in acres, so pounds per acre rather than pounds per hectare, but I don't think that makes any difference because we're actually just comparing the differences. Okay, so if we just jump through next to the next slide then and look at here. So machinery capital is a key item and a key problem actually in arable farming. And so we've got here LFB, which is Land Family Business, which is our benchmarking whole benchmarking group up to 100,000 acres, and the regen is about 20 farms who are operating 100% regen. Okay, so you can see here that this is in pounds per acre, and this is a 4-year average. So machinery capital per acre on traditional family farms is around about heading for 400 pounds per acre now, 396 down there. So, and that is creating quite a large problem in today's economic climate. So, and if you look at the regen group, it's 289 over that period, which is just about 107 pounds less. Okay, so that's the first key difference between regen and traditional farming. And as I said, traditional farming includes a lot of some no-till and quite a lot of min-till these days, and ploughing isn't that popular. So what is really interesting here is that in the regen group, we have a lower yield and up to about 20% lower yield on average. So what we're looking at is the differences between comparing the differences between those two key items, those two key benchmark figures of tons per acre, tons per acre and machinery capital per acre. So, and this is something, a benchmark we've developed to look at specifically for these groups. So machinery capital per ton of wheat produced. In the regen here, you can see it's 93, and in the standard farming practices, 109. And all the way through, the regen is between 90 and 100 pounds per ton. And in LFB group there, it has always been plus 100, so it's anything from 100 to 110. So there's key differences there, but it's so interesting to see that the machinery capital per ton of wheat produced is lower in the regen group, which means that the capital is lower, but also the yields are lower, but the machinery capital per ton is actually lower in the regen group. So the bottom line there, access to machinery. So I think the reason why we're looking at access to machinery is because different farms use machinery or are using machinery or fund the machinery in different ways. So depreciation is owning the machine. Contract is using contractors to do the work, and then obviously some farmers hire in combines, for example. So we need to add those together to what I call access to machinery. And again, LFB, the column there is 132 and regen is 95, which shows you need less machinery for the actual regen farming based on our benchmarking. So that's looking at the machinery part of it, okay, which is an important part, but actually bringing in that yield loss into the benchmark in that middle line there of 109 to 93. Okay, so let's move on now to look at some of the key actual margin differences. So the next slide shows here the 4-year average for actually regen versus traditional farming. So variable costs, £48 per acre. Again, we're dealing in acres. £48 per acre less than traditional farming. Labour and machinery cost per acre, £57 per acre less. But the output, as you can see, so this is over 3 years, the output, because I need to say a few words in a second about the 22 harvest, okay? But the output, £99 per acre less. But the bottom line there, which 1, 2, 3, 4, the fourth bullet points there, margin £9 per acre more in the regen group. £9 per acre is not a huge amount, so almost break even. And the conclusion that I've come to from all of this benchmarking is that there is hardly any difference in margin between the two. Okay, you see statements saying regen you make a lot more money, or vice versa, but the benchmarking that we've come out with, and this is based on, from accounting principles as well. We've used accounting principles in all of these, they're all like for like, that it is roughly the same. Okay, the 22 harvest I just mentioned. So what happened in the 22 harvest was that the traditional group went sky high, basically, because they had a higher yield, higher prices, actually leveraged up the margin hugely. So therefore, in the regen group is a lot more stable margin. Whereas the traditional farming is quite erratic, and the highs are higher and the lows are lower because of the higher costs. The other point in these figures here, we have excluded all the SFI. So there is specific SFI income subsidy, if you like, for regen or no-till farming available. But obviously these schemes are changing and there's new schemes all the time. So and they're only around for 3 years at a time. So therefore, we've excluded all the subsidies out of this completely. So the next really important point I want to make is working capital. So when you look at this, if you go back to the machinery of nearly £107 per acre tied up in machinery, okay, you need less working capital. And one of the biggest problems we're having in arable commodity farming at the moment is working capital, where arable farmers need more and more money just to have the same margin every year, and many of my clients are struggling with banks funding these as well. So therefore, having less capital employed in machinery, and also moving back to this slide here, having less capital tied up in variable costs as well, £48 per acre less. Therefore, you need less money for the same margin, is the conclusion. Okay, now that is really good at the moment, having less money less money needed for the same margin. And so what I do find in terms of when I do talks to agronomy groups all around the country, this last winter, talking about these figures, many farmers say they cannot get their head round and dealing with it. We've all been to, not we've all, many of us have been to ag college, and I've been to ag college where yield is king, and we've all heard that. And and we need to probably get out of that thinking of yield is king, and having that huge capital pouring into machinery, capital pour into variable cost to have that greater yield, using up a lot of money to achieve the same margin as if you did the regen group. Right, okay, so in the last few minutes, I just want to move on now. So some of the questions I get asked, if you need to change into move gradually into a regenerative agriculture, farming, and I haven't been through the definition, because I think we all know what the definition is of actually true regenerative farming, not disturbing the soil, etc., and all the others as well. So is accessing and buying a drill to start off with. You might need to buy a drill to actually have a no-till drill. So what we've done in quite a few farming businesses, like who want to move into these, is I want to end up on talking about a machinery syndicate. Okay, this is an example of a JV, joint venture. So what we have here are 4 farmers, okay, and so those percentages, which hopefully add up to 100, 20, 30, 35, and 15. They are the productive acres, just the productive acres, not the SFI acres, the productive acres that need machinery to farm, basically. And so what we do, we form a separate business, normally an LLP. Well, it needs to be an LLP, not a limited company for tax reasons. So a separate business down here, this bottom rugby ball, so where all the machinery is pooled. Well, those in this example, those 4 farmers, and I've got these structures up to, I think, up to about 10,000 acres per one business with 10,000 acres. And the smallest I've got is around about 1,600 acres, which is a bit small, really. But they average about 3,000 to 6,000 acres when farmers pool together. And with 1.5 combines or 1 combine, etc. So if each of these had a combine each, and obviously, and if they're farming, say, 2,000 acres, you'd only need 1 combine. So the key points that are made to me at this stage, when they say, well, that doesn't work, Gary, because we'll all be fighting over when the drill needs to be used, or fighting over when the combine needs to be out, etc. So what we do, or what I've been doing, is putting a share farming agreement in here above this machinery syndicate. So I've got these going. The earliest ones I've done was in the year 2000, so that's 26, coming up to the 26th harvest now. And I've had one didn't fail, one disbanded because it wasn't working for the individuals. So of 15 to 20 of these, I've got about 18 of these, I think, throughout the east of England. And so they've all been going using this share farming. So just to explain this in a few detail in a few minutes, then, is that so each one of these, as a percentage of the area they're putting forward for cropping, okay. So this one here would have 20% of the total farmed area of all the crops, so that all the gross margins are shared in that proportion. Okay, so it doesn't matter where the drill is or any the machines are. They're all equalized, basically. So that works really well. So a barrier to entry, is what people say in terms of changing farm practices. Is rearranging machinery, etc. And this structure here is a very useful way of actually regen farmers coming together, because the other point is that you've got it straight in your mind as well, and lose your. So many people dip their toes into regen and then lose their nerve and come back again, because traditionally we've been ingrained to have maximum yields and as I said earlier on, yield is king. We've all been taught that. So we've got to get that. So when you've got 4 farmers together working together, you can actually help each other gain the confidence moving forward. Okay, so that is a short session and concludes my thinking or my results. I'm not advocating any way above the other, of course, but actually just to finish, if we just summarize this, the margin is very similar in each one. However, you need less cash to actually run a regen farming group. Okay, so my final slide is thank you very much, and I hope you found that useful.